In that, in our earlier video, we have discussed about the operating exposure, how operating exposure can be measured, what do we mean by it, and with help of an illustration, we try to understand the way through which operating exposure can be measured, whether to go for hedging or not. So we have seen a different aspect of operating exposure or economic exposure. So we can take different set of examples to understand how operating exposure can be managed, the way of management of operating exposure, the firms which face operating exposure, how they can manage their this operating risk or operating exposure which they are facing due to fluctuation of the exchange rate. So for that purpose, we know that operating exposure it influences the operating cash flows of a business entity due to random changes in the foreign exchange rate. So the same thing is there when a firm is exposed to exchange rate fluctuation, or its business is related to some kind of imported content which is coming from a country and it is being sold in the host country market, then of course the operating cash flows can be influenced due to exchange rate fluctuation. But when we talk of this management of operating exposure, there is no set specific method through which it can be managed or streamlined. But there are certain ways through which it can be there. Like one such way is the selection of low cost production base. This is one of the reasons which compels the multinational companies to cross their national boundaries. For instance, let's suppose there are two countries, US and Mexico, and the US, there is a US subsidiary in Mexico, General Motors, and it is importing cars from US manufacturing facility. But if Mexican peso depreciates too much, then there will be a lot of pressure on the cash flows of General Motors Mexican subsidiary. In that case, the company can decide to relocate its production facility from US to Mexico, and of course exchange rate will not be the only consideration here. The low cost production side, because the Mexican wage rates might be they are less than the US wage rates. So companies many times they decide to relocate their production bases so that the continuous depreciation of host country currency can be settled out by shifting of production base. So if the US company it transfers its manufacturing facility from US to Mexico, in that case it will be having double advantage. One advantage is that since Mexican peso is having the depreciating trend, so in that case, whenever the cars are being imported from US, every time after depreciation, the import proved to be costly, and due to this, lot of pressure has been faced by the General Motors Mexican subsidiary. So it's good to relocate the production facility in light of one such factor. And second one is the this low cost production side. The wage rates are low, then company can go for if it is able to establish research and development facility more on that, so more diversified products can be there, and company can increase the prices because there may be less competition from the market, because competitors may not be having that product, that particular technology. So company can take advantage of that research and development investment. So in nutshell, the shifting of production base, then of course one or not only shifting of production base but low cost production side, then research and development investment, and then one very important thing is that the companies which want to manage their operating exposure, they can also look for some kind of financial hedging techniques, like one that we have discussed when we were discussing the example of operating exposure, that if the company is able to forecast its cash flows or is able to calculate its operating exposure, then company can take some kind of forward cover or options cover over its future cash flows in a currency which might be adverse to its interest. So through that the company can manage its operating exposure. Then apart from that, there is also one very important technique which we can understand, what we call the flexible sourcing policy. Now, nowadays we all know that the supply chains are varied. The products which are manufactured throughout the world, not a single country can claim that this product is totally being manufactured in this particular country. So the supply lines are scattered throughout the world. A typical manufactured product may have been manufactured, its components or inputs may have been manufactured in more than dozens of countries. So if supply chains are diversified, if it is spread throughout the world, then the currencies which might be depreciating, that can be taken care of the currencies which are appreciating. So not all currencies may be depreciating at one time or at one go or simultaneously. So few currencies might be depreciating, few currencies might be appreciating. So the depreciating one can be nullified with the appreciating one if you have diversified sourcing policy. If we are taking the raw material or components from, let's suppose, from two countries, against the one country our currency is depreciating, so we can search for sourcing of our raw materials or components from a country from where our currency might be appreciating. So due to that depreciation of one particular against one particular currency, that the losses in terms of operating cash flows can be cancelled or nullified because of dealing with a country against which our currency might be appreciating. So if a company is able to diversify its sourcing policy, if company is able to source its raw material or components from more than different locations, so the company may be able to face this operating exposure in a better way. Then one very important question comes in case of managing operating exposure, and the role of foreign exchange in that. That is make or buy decision. Make or buy means should we make a product in Mexico or we should buy it from our US parent company. So this foreign exchange rate of fluctuations in the volatility in the foreign exchange market also influences this decision. So when we have discussed the first factor, that the company may also think of shifting its production facility from US to Mexico. So this is what we say make or buy. So instead of buying it from the US parent company, the company has decided to make it in Mexico. So this is how the volatility of the exchange market, it influences most of the companies from developed world to prefer a country where there is low cost production, the wage rates are competitive, and the currency might be favorable. When we talk of Mexican peso, this example, the Mexican peso is having a depreciating trend, like it is also in case of India and US. So Indian currency is always having most of the times it is having a depreciating trend against US dollar. So the companies which are catering Indian market through imports from US, it is costly for them. Every time they have to shell out more Indian currency to get $1. So for those companies, it is better to relocate their production facilities or manufacturing facilities from their country, from US to India. So this is one of the also primary reasons that why companies from developed countries, they shift their location from their country to developing countries like India, because these countries have a continuous trend of depreciation of the currency. So these are the ways or means through which a company can manage its operating exposure, and it can remove the risk which may influence which may result in the decrease of operating cash flows, that is the profit of the company. So thank you. So in a nutshell, we can say that a company which is facing this kind of operating exposure, it should have a proper hedging strategy. So first thing is that the company should decide whether there is an exposure or not, and if there is an exposure, then what is the quantum of the exposure, and once the quantum of exposure is being determined, then the firm should decide whether to hedge or not. And if the decision comes in favor of hedging, then what should be the hedging instrument? So these are the hedging instruments which we have discussed in case of operating exposure, that is shifting of production base, or selecting low cost production site, investing more on research and development, diversification in the product offerings, and then the financial hedging techniques are of course there, which can be utilized for the purpose of managing this operating exposure. Now, this financial hedging is not only meant for managing operating exposure, it can also be used for managing other exposures like transaction and translation exposure. So that we will discuss in the next video. Transaction exposure is also called as contractual exposure, because this comes when in the trade and business, when a firm deals in foreign currency and when sales or purchase takes place, then this kind of exposure is being faced by a firm. So that this we can understand with help of an example. Let's suppose there is an exporter or importer. Exporter is from India and importer is from US. So both have signed a contract on first of, let's say on 1st of April for supply of certain commodity. So on 1st of April, the prevailing spot rate is being used for signing the deal. Let's suppose the size of the deal is $1 million, and on the day of striking the deal, on the day of signing the deal, the exchange rate between Indian currency and US dollar was $1 is equal to 70.1234. So $1 is equal to 70.1234 on 1st of April this year. So this is an assumption that on the day of signing the deal, the exchange rate between Indian currency and US dollar was this $1 is equal to 70. Now, as per the contract, the supply will take place throughout whole month of April. So by 30th of April, the whole supply will be finished and importer will make payment. And the payment date is 30th of April. So let's suppose on 30th of April, and remember that deal size is $1 million, and on 30th of April the importer will be making payment of $1 million US dollar. The mode may be different modes. So let's suppose on 30th of April the payment is being credited in the bank account of the exporter. So exporter has received $1 million. So as long as dollar is concerned, there is no problem. On 1st of April, the exporter was supposed to receive $1 million. On 30th of April, the exporter has received $1 million. So there is no difference in that in terms of receiving dollar. But the issue comes when the exporter is going to convert $1 million into Indian currency. If exporter would have received this $1 million on 1st of April, the spot exchange rate was $1 is equal to 70.1234 rupees. So it means if exporter would have converted $1 million US dollar on 1st of April, he must have received 70 million rupees, roughly 70 million rupees. But on 30th of April, so for the exporter, the deal size is $1 million US dollar or 70 million Indian rupee as on 1st of April. But on the day of actually receiving the payment, that is on 30th of April, will the exchange rate be same as it was on 1st of April? So this is not certain. Of course, the exchange rate will not be same as this one. The exchange rate may be like, let's suppose the 1 month after 1 month the future spot rate, the spot rate comes out to be 69.1234. An assumption 69.1234. So what happens here? So in dollar terms, the exporter is receiving $1 million. But in Indian currency terms, when exporter will convert dollars into Indian currency, the amount the exporter is going to receive, it is less than what exporter would have imagined to receive as on 1st of April. So this is nothing but loss of cash flow because of appreciation of Indian currency. Now Indian currency has appreciated in the spot market in comparison to 1st of April and on 30th of April. So this proves to be a loss of cash flow for the exporter. So here this is a transaction exposure. Why this is a transaction? Because the contractual obligation, the export and import is a contractual sales. So the thing is that importer has to make payment of $1 million on 30th of April. Exporter has to receive, and if the exporter is going for conversion of $1 million on the basis of the spot rate which is prevailing on 30th of April, then exporter will suffer the losses in the cash flow. So this kind of exposure we call as transaction exposure. The opposite of this thing can also happen. If a spot rate comes out to be, Indian currency might also depreciate. So we all know that one thing very important, that if Indian currency depreciates, it is advantageous to the exporter. If Indian currency appreciates, the exporter is at disadvantage. So here, if Indian currency appreciates to 71.1234, so it is but natural that now the exporter will receive in Indian currency more than what it has imagined on 1st of April. So here exporter is maybe having some gain due to fluctuation of exchange, favorable fluctuation of exchange rate. So this is what we call transaction exposure. We don't know in which direction the spot rate will go, and this may lead to positive cash flows as well as negative cash flows. So this is what we call transaction exposure. And now the ways of managing transaction exposure, how to hedge this transaction exposure, which is very important thing. Because that most of the businesses, they are either in international context, the exporters are involved, importers are involved, the investments are being done. So this hedging of transaction exposure is very, very important phenomena. And one such technique is we can divide the whole hedging philosophy of transaction exposure into two categories. One is financial hedging, and other one is non-financial. Under financial, we have already discussed in our earlier videos. Again, we will discuss a little bit about the application of financial hedging in case of this transaction exposure, and then non-financial hedging techniques. So under financial hedging, we have forward contract, futures contract, options contract. And under non-financial, they are like leading and lagging of payment. Then we have invoicing, then multilateral netting, and so on and so forth. So let us discuss little bit about financial hedging instruments. So under financial hedging instrument, forward contract is the first one. So I will not go in detail of that. If you want to know what is forward contract, how it is used for hedging this foreign exchange exposure in terms of transaction exposure, so you can refer to the video of forward contract. So, but I will give you in a brief how it can be applied here. So, a forward contract can be struck by the exporter here, where exporter can deliver $1 million 1 month ahead, and the rate of exchange rate between Indian currency and dollar will be locked. So here exporter will take 1 month of forward contract with any foreign exchange dealer. It can be bank or it can be authorized dealer, any dealer, and there the rate will be locked. The rate may be 69 or 71 depending on the forecast of the market. So this is how through this the exporter will be successfully able to streamline its cash flow. Means it will get away with the uncertainties of the future spot market. So this is how the exporter can manage its what we call risk in terms of streamlining of its cash flow through forward contract. In case of futures contract, there is no, as we have also discussed in the video of futures contract, there is no direct applicability of futures contract in the currency market. But currency futures trading in India is also relatively a newer concept. For last 10-12 years, we are seeing that derivative arm of NSE is offering that. But there is an indirect application of that. So let us discuss little bit about that also. Like if this is an example through which I will like to explain you the indirect application of futures contract in transaction exposure hedging. So let's suppose there is an oil importer. Oil importer is there, and the international oil market. In international oil market, the oil prices are increasing. So due to that increase, there will be a loss, because the importer has to make more payment. Importer has to make more payment. So if a country like India, which is heavily dependent on international oil import, So there will be an impact on the depreciation on the value of Indian currency. So Indian currency will also depreciate. So this will heavily impacting the cash flows of the importer. So what will happen? So here, if international oil market the prices are going up, then the importer can take an opposite position in the commodity market. So importer can purchase oil futures, because we all know that this is a global market, the financial markets are interlinked. So if oil prices in international market they will increase, then oil future prices in our commodity exchanges they will also tend to increase. So if the loss being suffered by the importer due to increase of prices in international oil market, now that may be to some extent nullified or cancelled due to increase of prices of oil future. And we know that in futures market the settlement is on the basis of mark to market. So on daily basis importer will be having some amount of profit as the oil futures price will increase. So the losses which importer is going to suffer due to depreciation of its currency and increase of oil prices in international market, it may be to some extent cancelled or nullified due to increase of oil future price. So to that extent it is applicable. And the third one is options contract. So the same, we all know that what is options contract and its application in hedging. So as the stock oil futures is used, so similarly on the base, options contract can also be used as far as hedging or forward contract this transaction exposure is concerned. Now let us discuss little bit about this one, non-financial hedging techniques. Under non-financial hedging technique, one such is invoicing. So if the exporter of India is able to convince the importer of from US to hedge or to invoice the bill in its home currency. So if the invoice of currency is Indian currency, then the risk will be shifted from exporter to importer. Now importer will be facing all kind of transaction exposure, and there will be no exposure being faced by the exporter. So just take the same example. If $1 million is the size of the deal, and the exporter says that we are willing to receive payment in terms of Indian currency, and the spot rate that will be applicable is 1st of April. So if on 1st of April the rate is 70, so exporter demands 70 million rupees from the importer. So it means that exporter will be receiving 70 million rupees. So now conversion of currency, it will be the responsibility of the importer. So risk is being successfully shifted from exporter. Exporter has shifted risk from its shoulder to importer. So now all the exposure will be faced by the importer. So this is also one technique through which the exchange, this transaction exposure can be avoided. Then other one is leading and lagging of payment. If you are an exporter, you will see that your currency is appreciating, and if you are going to receive payment on 30th of April, and this may result in losses, so you may ask your importer to delay the payment so that this speed of appreciation can be reverted back, and this currency again starts depreciating, because we know that this exchange market is volatile. The exchange rate it depends on so many factors. So exchange rate can go in any direction. So exporter can ask its importer to delay the payment, so that is lagging of the payment. Or else if the exporter analyzes that the market next month or in coming future it is not going to depreciate, it will be having an appreciating trend, so it may request the importer to lead in payment, means go for some kind of before due date payment. So if due date is 30th of April, so it may request the importer to make payment 1 week or 10 days before, because a slight change in exchange market may result in crores of rupees of difference in the cash flow. So if importer makes payment 1 week or 10 days before the due date, so this may result in the savings to the exporter. So this is leading and lagging. And third one is multilateral lending. So if what happens that if we see that our currencies, Indian currency is going to appreciate in the coming future, so we may take some offsetting position in a currency where we will be having advantageous position. Now as an exporter, if our currency appreciates, then we are at loss. So it's better to take an offsetting position in a currency which we are assuming that against that Indian currency will appreciate or depreciate. So if we are, here in this, if we are an exporter, our responsibility is to convert in US dollar into Indian currency, and because of appreciation of Indian currency, we are, we are visualizing that we will receive less Indian currency. So if we are striking some kind of offsetting currency position, so like, if we struck a deal, if we purchase, let's suppose, if we anticipate that for coming time the Indian currency will also appreciate against the euro. So what may happen that if the exporter can purchase now this euro, and it can sell at a higher price a month later on. So if at present euro is costing 80 rupees against 80 rupees against 1 euro, so it might be possible after 1 month of time 1 euro may cost 70 rupees. 1 euro may cost 70 rupees. So here if the exporter thinks that the euro is going to appreciate or Indian currency is going to depreciate, so here if on the day of striking the contract with the importer who is in US, and exporter here it is taking an offsetting position because it is forecasting that Indian currency may depreciate against euro, so it may purchase at present by paying lesser Indian currency some euro amount, and after a month's time it will sell at a higher price, because Indian currency is going to depreciate. So this is what we call some kind of netting position, to take an opposite situation, opposite stance in a currency which might be proving fruitful to us. Apart from this, netting is also applicable where there is multiple payments. Like if we are going to receive US dollar, 1 million US dollar, and we need to convert it into Indian currency. So we, on one side, in most of the trade business, international trade business, the exporter is also on other side importer. It is importing raw material component and inputs from international market. So it has to make payment. So rather than receiving payment from the importer of the final product, the exporter may ask its importer to make payment to its exporter. So if let's suppose we are exporting some commodity to US importer, and we have imported some raw material from South Africa, then we may ask our importer to make direct payment to South African importer, and South African importer which was exporting us, and we were the importers for that, because we were purchasing raw materials, and those raw materials we were converting into final product, and then ultimately we were exporting to US market. So we also need to make payment to South African importer, so we can ask our importer to make direct payment to our exporter which is residing in South Africa. So in this way the total exposure can be reduced. Total exposure, not complete reduction of exposure can take place, but at least to some extent the exposure can be reduced. So these are certain techniques which can be used for managing transaction exposure. Thank you.